Hello everyone, I'm David Smerdon and welcome to this lecture about money and inflation. But before we get into today's topic, as per normal, a little bit of feedback, a few practice questions for you to get us underway, picking up where we left off last time, discussing things such as GDP and macroeconomics in general. So, the first question for you is, which of the following is not one of the four main policy concerns of Australian macroeconomic policy? The rate of economic growth, the circular flow of income, the unemployment rate, and the rate of inflation. Well, all those terms seem familiar from last week, I'm sure, but which one is the correct answer? Why don't you have a go yourself? If you need more time, pause the video now. Well, there are a number of main policy concerns of Australian macroeconomic policy. I put four in there because there are four different options, but there are three main ones that we focus on, which are about GDP, unemployment, and inflation. The circular flow of income, while important in describing the macroeconomy, is not one of them. Next question. Total production in the economy is measured by the total number of goods and services produced in the economy, the market value of all final goods and services produced in the economy, the total number of goods produced in the economy, and the total number of services produced in the economy. Again, have a think about it and pause your video now. Well, when we need to get a gross domestic product or some sort of measure of production, we need to do it in terms that are comparable to both our own country over different time periods and also to different countries today. We need to be able to compare apples with apples, so to speak, but in particular, we're talking about the value of those apples. So what we need is something that we can compare, which is the market value of all of the final goods and services produced in the economy. Question 3. GDP is the value of all final goods and services produced in a country during a given time period, the sum of consumption, investment, government spending, and net exports during a given time period, the sum of the market value of final production rather than the quantity of production during a given time period, or D, all of the above. Pause your video now. Well, there are different ways to think about GDP and different ways to measure GDP, but at the end of the day, the concept is the same. And that concept is about that value of a country's domestic production during a given time period, and it can be measured in all three of the ways given here. And finally, a slightly philosophical question, but usually in economics, the philosophical ones are kind of the more important ones in my opinion. So, question 4, explain the shortcomings of GDP as a measure of total production in an economy and as a measure of economic well-being. No multiple choice this time, just something for you to think about, see if you can come up with one or two or three different reasons that you would put forward as shortcomings of using GDP as a be-all and end-all for capturing production and economic well-being. And pause the video now. Well, there are different arguments that you can make and different arguments that have been made by many people about this topic. And economists are getting in on the act these days as well, not just restricting themselves to being on the side of pushing GDP as a measure, but also pointing out its drawbacks and putting forward alternatives. But here are what I think are three of the key drawbacks of just putting too much weight on GDP. First is that it doesn't count household production, such as housework and chores that you do at home, or the time and care that a parent, for example, puts into taking care of their child. So to me, it doesn't make sense if, say, a mother decides to go to work to be a school teacher and she pays a full-time au pair to look after her child. We would then count both of those employments as GDP. If instead she stayed home to take care of her child and that au pair took a job as a teacher, we would count the au pair's production, but we wouldn't count the mother's production, even though it's really just a switching of roles. So that's one thing, and this obviously counts more in countries where this is more common and more of a component of the way that domestic households allocate their labour, which proves to be something to take into account when you compare across different countries. Another thing that gets in the way when you compare across countries is how much underground economy is going on. These are transactions where often there aren't receipts, taxes, it's not recorded on tax statements so that the government doesn't have a record of it when it makes its GDP calculations. And again, this differs from country to country. So these can be just sort of rural marketplace transactions where there are no records kept at the end of it, or these can be black market sort of activities as well. And the final thing that I think is very important, particularly when you put stock in GDP as a measure of well-being, is that it doesn't take into account leisure, it doesn't take into account pollution costs, crime costs, equality or conversely inequality, feelings of safety, arts and culture, and so forth. So for example, when we think about things like leisure and a clean environment, the more that people work, the higher your GDP is going to be if everyone's pulling 60-hour weeks, but the lower the average time for relaxation of the individuals. So is it really fair to be calling that a higher well-being when people are relaxing less? And that same sort of trade-off is seen when it comes to pollution and a clean environment. So the more production you get can often come at the expense of higher pollution levels. And how do you take that into account? Okay. That's our feedback for today. What we're going to look at, we're going to start by focusing on money, what it is. We're going to introduce some more players into our models, in this case, financial institutions, and in particular, the Reserve Bank, the central bank in Australia, is going to play a big role. We're going to talk about monetary policy, the commercial banks and the creation of money, the money market, and then move on to inflation for the second half, less than half of this lecture. So what is money? Well, that seems like a very strange question to ask, one that you don't think is very economics-y. It's a bit more philosophical, you might say. But actually, it's important for us to define what money is, because many things can be money. So it has three key properties, whatever we decide to use as money. Its properties or its purposes, its benefits are that it is a medium of exchange. So you go to the market and you want to say, well, I'm a tomato farmer, you're a coffee bean grower, I would like a sack of coffee beans, I would like to trade with you for however many tomatoes I've got and so forth. But that gets difficult. You've got this bargaining, this negotiation and so forth. Much better to have some sort of medium of exchange to make these transactions a lot more fluid. Second, it's a store of value, which means that you don't necessarily have to have stuff to trade with the other party at that time, at that moment. You can earn your wealth at a different time, store that value in this sort of currency, and then exchange it to buy things. So that's important. And the third is as a unit of account, so that we can keep track of what different prices mean. For example, if I trade, if I trade a kilo of tomatoes for 200 grams of coffee beans, and over there at the next market stall, they trade 2 liters of milk for 500 grams of chocolate. How do I work out how much a tomato is worth compared to a block of chocolate? I mean, it's very difficult to compare across like this. We want to find some way to centralize things so that we can get an accurate yardstick to measure things by, just like we use centimeters or meters for length, kilograms for weight. So that sort of money is something that we can use as an accounting measure to help us keep track of these sort of prices. And that means that many things can be money as long as we just keep to these three benefits and also have a few other features that mean that these things are actually practical. First is that it must be acceptable by most people. For example, if we make shells our currency that we're trading, which has been done in different civilizations over the millennia, it's got to be the case that if I sell you my tomatoes and you give me a handful of shells, I need to know that I can go and buy something with these shells. It must be acceptable. Of Of course, if it's got the stamp on it, the royal seal of approval, it's got the Roman Empire logo on it, or it's got the Reserve Bank of Australia governor's signature on it, as does our currency, then I know it is going to be acceptable by most people, and that's okay. It's got to be durable. It's got to be able to last over time. It's got to be transportable. I think there is one island in Micronesia, I can't remember it off the top of my head, where one form of currency used to be huge rocks, big rocks. The point being that, well, it's got some intrinsic value because you've got to spend time to dig up these huge rocks, but they're not transportable. It's got to be standardized across the board, such as with the Roman Empire, those coins needed to be able to be kept to a standard measurement, standard quantity of silver and so forth across all of Europe into Northern Africa or into the British Isles, and divisible in that we can divide it into small enough units that we can buy small enough quantities of things without too much trouble. Now, this means that we can think of many things that actually fit the bill. It doesn't just have to be things like silver or gold that we've thought about before, or shells or beads like I mentioned before. In different countries, you will have different sorts of materials, natural materials that have been found. Blocks of tea have been used before. What else? In The Hitchhiker's Guide to the Galaxy, a famous book written by Douglas Adams and made into a TV series and movie and radio show, the human race, a primitive civilization, actually falls apart when they decide to use leaves as their stock of currency. It does technically fit all of these elements here, although they're not particularly durable, for example. And of course, they ran into rampant inflation problems, but we'll talk more about that at the end of the lecture. One thing about durability, by the way, Australians are not known for many inventions. We like to take credit for the invention of the Wi-Fi, and it is true that an Australian had some role to play in the development of Wi-Fi technology. Other things like the Hills Hoist clothesline and Velcro, you'll have to look up for yourselves. But one thing that we did do, which is quite interesting, is to improve the technology of banknotes, in particular coming up with waterproof banknotes with better security on them. And in prisons, you actually find very interesting forms of currency, because often money is not allowed to be used for transactions within prisons. So what are the things that fit these bills that are acceptable to most people? Well, you have things like cigarettes. At one stage, you had canned tuna. My favorite is urine, particularly when there are regular drug tests. So urine samples actually have a store of value. And in other countries, I remember there were also bottle caps and cocaine in Colombia during a period where the official national currency was not worth very much. These sort of features of money and the effects that changes to these features can have are very important fundamental features of macroeconomics. As we mentioned last time, failure to appreciate these things can lead to much bigger problems. And there have been arguments about what led to the decline of the Roman Empire, as I mentioned last time, and the fact that this idea of trying to debase the currency by reducing the quantity of silver from 100% silver all the way down to 5% silver actually led to a destabilization of the economy of the Roman Empire and led to this famous crisis of the 3rd century. Now, there were a lot of other factors going on at the same time. Some of those factors actually led the emperors to come up with these supposedly macroeconomic solutions. But still, it's interesting to see how this is acted throughout time. So by the time they actually moved from around the beginning of the modern era to the 3rd century, the coins had almost no silver at all. And so there'd actually been a transition from commodity money to fiat money. And these are the two different types of money that we can have. Commodity money, there actually must be some intrinsic value to those. So gold coins are made of gold, silver coins are made of silver. But fiat money, which is the more common one today, it just needs to be believed by most people to fit those requirements that we said before. So even if it's just a piece of paper or a bottle cap, as long as it's got the Reserve Bank of Australia's official seal on it, we know that it's going to be accepted in most places, and it's got value that we trust, because as societies throughout history developed more into these larger state-like structures with rule of law, trusts in institutions and property rights and so forth, then having these sort of seals or sort of guarantees by some sort of authority figure actually count for something. So that's what we have in Australia, as in most countries. Our Central Bank of Australia is the Reserve Bank of Australia, or the RBA, but most countries have a central bank, and usually they have the role to issue this sort of currency and to ensure that the features required of this currency to act as money are satisfied. So that means that money is not just as simple as thinking about it in terms of notes and coins. And that makes sense because actually probably most of your recent transactions, definitely during the COVID period, were not making use of physical money. Usually it would be either on a card, for example, so it was an electronic transaction that way through a physical tapping, or through a direct deposit, or coming out of your account, or purchasing online through PayPal or something like this. So we need to think about what money is in terms of the transactions that are happening every day, or at least the capability of a country to engage in those transactions. Still, we can think about the monetary base in terms of these physical elements. So the monetary base of a country is the physical currency, plus the reserves that the central bank holds on to itself. And it's a very narrow definition, because if you have $10,000 in a bank account, that does not mean that the banks are holding that $10,000 within its vault somewhere. It's usually holding only a fraction and using the rest of your money to do something else, hopefully to make a profit for themselves. That's sort of the point of banks. That's why they offer these sort of facilities. Now, of course, the flip side of this is that if everybody wanted to withdraw their money at the same time, they couldn't do it. That money is not there. Now, 99% of the time, that's not a problem. But when it is a problem, it's a big problem. And we've seen recent examples of this during the European financial crisis, and particularly in countries like Greece, also Portugal, Italy and Spain, but particularly in Greece for a long period of time, people were permitted to take out a maximum of 60 euros per day from the ATMs. That's about 100 Australian dollars per day, and no more than that, because there weren't those physical reserves held there. So that's a situation called a bank run. So this definition doesn't really help us to think about the capability for transactions, or the potential for monetary transactions to happen throughout the day. The Reserve Bank defines the monetary supply in different ways, and which definition we use depends on which macroeconomic question we want to answer. But what we're interested in here is just seeing sort of the difference between the two, and particularly how these two definitions differ from the monetary base that we saw before. So the ability of people to pay, we also want to take into account not just the physical currency, but also that numerical amount on your balance sheets, that sort of current deposit amount that you might have at one of the commercial banks. Now in Australia, we have many commercial banks. Typically, we've talked about the big four in common lingo, sort of this oligopoly of banks. More and more, particularly since the recent royal inquiry into the banks, royal commission into the banks, there has been a little bit more of an appetite by the consumers to look at other banks outside of the top four, which is good for us as consumers. More competition, we know what that means by now. So there are other things, particularly in your check and savings accounts, that will add into this M1 definition. And we're typically here talking about money that you could access very quickly. So say you wanted to buy a loaf of bread, you could use these sort of stocks within your M1 to buy your loaf of bread today. However, there are other assets in terms of your wealth, or things that you hold at a bank, that you couldn't just take out immediately if you wanted to go buy something today. Things like term deposits, for example. So typically you'd have to pay a small penalty there. When we add up those sort of things, plus deposits at other authorized deposit-taking institutions such as credit unions, we get to what's called the M3 stock of money. So it's so then we're talking, if we're interested in questions that don't depend on people being able to pay instantly, then we might be more interested in M3. Now the M3 definition is much larger than the M1 definition. The RBA has a lot more information about the definitions in case you're interested in these things, but you can see here that adding in these extra features on top of M1, so they say all other deposits of the private non-ADI sector at banks. So I've got some extra information in the footnote there about that. Leads to a much bigger value or share of GDP. And across time, it's almost as if that gap has even begun to widen. So you can see that M3 is much larger than the other two. So now we've sort of got an idea of defining what money is. It's time to bring in our players into talking about money. Now there are two sort of groups of players we're interested in. We've already spoken about the RBA, our central bank. The other group is commercial banks. Now they provide financial services. We know that for most of us that means somewhere to store our money besides putting it under our bed where we can actually get a little bit of interest. They also do other things. If you've ever taken out a loan, they can provide those sort of things. They can provide other sorts of investment products as well. And they're not just providing these services to you and I, they're providing them to small businesses and to larger businesses, medium-sized businesses, big businesses, businesses who need to be able to access this sort of financial capital quickly in order to invest in their production and to grow their business. Let's focus on the RBA once more. So the RBA Act, or Reserve Bank Act of 1959, sets itself three objectives. The first is the stability of the Australian currency. The second is the maintenance of what we call full employment in Australia. Now, full employment is that everyone who's sort of currently looking for a job and able to get a job can get a job. It doesn't necessarily mean that we have 100% employment, but those sort of definitions are not so important for what we're talking about. But just note that somewhere around that 4 to 5% unemployment mark is what we would call full employment. And this third, slightly philosophical definition, the economic prosperity and welfare of the people of Australia. But perhaps more importantly, it's got some particular functions that it engages in to achieve these objectives. First is that it is the only issuer of national currency. Now, again, as we go through today's lecture, there are some little, some slight inaccuracies that I'm telling you. There are some little, say, exceptions to the rules, but for the most part, I think we'll just ignore those and focus on the bigger picture. So for the most part, 99% of the time, it's the only issuer of national currency. It is the banker to the commercial banks and to the government. Obviously, the banks have to have their own bank that they can go to. And it is a lender of last resorts to the banks and large financial institutions, which is going to be important when we talk about setting the interest rates. And it sets these interest rates by way of the channel system. So to implement monetary policy is the term we use for policy that's enacted by the central bank or that involves the money supply. It does this by influencing the quantity of money supplied. It's a system whereby the central bank adjusts the rate at which it borrows from and lends to the other commercial banks, that in turn influences the market interest rates, that in turn influences the rates that you and I see when we decide whether to put our money into term deposits or whether to take out loans and so forth. The channel system works on a daily basis. So every day we buy stuff, we sell stuff, we deposit stuff, we take money out. Businesses do that, individuals do that. And at the end of the day, our commercial banks might be owing money to other banks, or they might be owed money from other banks. You know, I've got an account at Commonwealth, you've got an account at ANZ. Do I transfer money to you on paper? Do you transfer money to me on paper? That's going to affect how the Commonwealth and ANZ interact at the end of the day. Now remember, they don't hold all of your money or my money in their reserves. So if at the end of the day they need to try to clear these transactions and the Commonwealth finds out that today they owe money to ANZ, they can do that overnight in this sort of overnight market. So the Commonwealth Bank can borrow at the overnight market, but of course when you borrow money, you pay a price, and that price is the interest rate. So you probably already know what the interest rate is. You've all encountered them before at some point. It's the amount paid per dollar, typically borrowed per year, typically, usually expressed as a percentage of the overall amount or principal amount borrowed. It's really the price of borrowing money. If you want to buy something, in this case money that you don't have, you pay a price for it, and it's that extra buffer on top. The cash rate is the rate of interest that's charged by one bank to another for this sort of interaction that they engage in the interbank market every night. Why do we care about what these commercial banks are doing with each other at the end of the night? I don't care. I've paid money from Commonwealth account to your ANZ account. You get it and it's sitting there. Why do we care about these guys? Well, what these guys are doing overnight and the interest rates that they are trading at in their own little market affects the interest rates that you and I see. The interest rates that we get when we decide that we're going to go and put money in a term deposit, or that we're going to get a home loan or something like this. Different central banks have got different target interest rates. Typically in these Western democratic countries with similar sort of OECD style economies, they're going to be similar to each other across the board. We've got the RBA and the New Zealand one here in red and blue. You can see that we also tracked the US for a period of time until they really got started on dropping us all down with their subprime mortgage debacle, which led to the global financial crisis hitting around that 2008-2009 period, when we in Australia and the New Zealanders also began to feel it. And there's been a little bit of a gap in the years since then as the US has tried to recover. Now, we also mentioned that the RBA is a lender of last resort and a borrower of last resort. So what if a bank can't borrow or lend enough in their own market? Well, then they can go to the RBA and they can borrow or lend there. And typically there's a slight penalty for doing that. They are, after all, the bank of last resort. And as I mentioned, once they engage in all these sort of transactions, those interests, or whatever the market, their overnight market is going to set the interest rate at, is going to flow on to you and I. So if you're wondering how the banks come up with how they change those rates on a daily or monthly basis, it's coming all the way back from how the RBA, through its channel system, is driving the overnight intrabank market and is flowing on to us. So let's take a look at this graphically. These are the Australian interest rates, and what we've got is the RBA target rate right at the bottom there, small business lending rate, large business lending rate, and then a variable housing loan. So if you and I want to go and get a house, this is the sort of home loan that we can expect, and you can see that it's always much, much larger than what the newspaper will report is RBA cuts interest rate to whatever, 2%. That doesn't mean that you and I can get a variable home loan rate at 2%. It means that we're getting a variable home loan rate at 7.5%, but it's going to move on the level in a similar distance from that RBA target. And those that distance sort of reflects the risk premium. So for someone who's taking out a home loan, they're obviously a slightly more of a risky country than a small business taking a loan. So that's going to be reflected in that sort of spread. Okay, I mentioned before that the RBA's actions in a policy setting are called monetary policy. So let's define monetary policy. This comprises the mechanisms by which the central bank, typically a central bank, but it can be another monetary policy authority, controls the supply of money, and this influences both the interest rate and consequently the inflation rates. And obviously that's going to affect what you and I do when we decide whether to buy stuff, to save stuff, to borrow stuff, to lend money. All that sort of stuff is going to be our decisions are going to be affected by both the interest rate and the inflation rate. And the same for businesses when they choose whether or not to invest. In Australia, this monetary policy is really about setting the appropriate level of the target cash rate. And they do this to try to maintain a narrow range for inflation, typically around 2 to 3% per average. So that's sort of the target inflation rate. And to try to keep the range narrow, like I said, so to reduce the fluctuations, reduce that sort of uncertainty. And so what the RBA does is it adjusts the quantity of money supplied to try to attack that sort of range. And I realize now that I'm sitting over some of the words where I am now. Let me just try to make my, I'll just move myself over a little bit, make my face a little bit smaller. There we go. Okay. So how does the RBA do this? Well, one way is through open market operations, or OMOs. Now, the money market depends on our typical forces that we're very familiar with by now, supply and demand, and that gives us our equilibrium, and that in this case, in the money market, the price that we're getting in equilibrium, remember the price is the interest rate. Now, the RBA can try to set a target cash rate. So the RBA is now going to target this month 1% as an interest rate. You might hear that on the news. To actually get there, it conducts these operations called open market operations, where it adjusts the quantity of market supplied by buying and selling different sorts of products or funds to and from the commercial banks to influence the cash rate. So what do we mean by this specifically? Well, if the RBA wants to increase the monetary base, pump more money into the base, what it does is it buys government or treasury bonds or securities from commercial banks. And when it buys these bonds, it removes these treasury bonds from circulation and exchanges them with money. So it sort of puts more money out there into circulation through the monetary base. Now, what does that mean? Well, it means that it increases the reserve amounts that commercial banks are holding onto, which means it's less likely at the end of the day that they're going to need to borrow any money in order to clear their debts. Commonwealth finds out that it owes ANZ money, but it's got more money sitting to pay for this now because the RBA bought some of its government or treasury bonds. So the Commonwealth Bank can just pay with that money and it doesn't have to borrow any. Now, of course, it may not be that simple, but in general, it releases the pressure for the commercial banks to have to borrow, which drops the interest rate. On the other hand, to decrease the monetary base, the RBA sells these government bonds or securities. So you might have purchased some bonds yourself in the stock market or so forth, or you would have, when you get a term deposit, you're essentially purchasing a bond, some sort of contract from a bank where you put your money in and you get it out later with some rate of return. So in the same way, the RBA can sell these sort of securities to commercial banks. The commercial banks pay with money for that, which that means that they've got fewer reserves, which means it's more likely they're going to need to borrow in the overnight market, which means that that's going to put pressure to increase that price of borrowing, which is that interest rate. So why would the RBA want to do these things? Well, it's got to do with whether they want to slow down or speed up the economy. Now you might say, why would you ever want to slow down the economy? Well, when the economy is going very fast, it can start to overheat. Now, what do we mean by an overheating economy? Well, it's putting a lot of pressure on inflation to rise, prices to rise. Things are going so well. And that is a good thing, that the economy is growing, but not always. Inflation, particularly high inflation, as we'll see, can affect different groups of the economy in different ways. People can get left behind, inequality can grow. It's typically not a good thing. Now, China's been an interesting example because for many decades they hit this sort of double-digit GDP growth combined with price increases, and they managed to keep it under control. It's very few countries have been able to do that. So for the most part, we're looking at trying to target slow but steady single-digit growth combined with single-digit inflation or price rises. So if the economy's growing too fast and our inflation is sort of pushing outside of that 2 to 3% range, the central bank can try to rein things in, try to smooth our growth. And it can do this by raising the cash rate. So how does it do this? How does it increase the interest rate? Well, it can sell government securities to banks. When it sells government securities to banks, as we've seen before, the banks pay for those with money. That's going to increase the chances that the banks are going to have to borrow money in the overnight money market because they've got less cash reserves. And that means that the interest rate is going to rise. What happens when you see a higher interest rate? What do you do with your money? You were thinking about buying a motorbike, but now you see that you can get a lot more money if you put it into a term deposit. Maybe you switch to the term deposit option. So your consumption's gone down. You haven't bought that motorbike. Or maybe to buy that motorbike, you were going to have to get a loan or put it on your credit card or something. It'll be a big credit card. Well, now you see that that interest rate you'll have to pay on the credit card or on that loan is higher, so you decide not to buy that motorbike. And we take those sort of decisions, those changes in decisions across the entire 30 million strong Australian population, and you can see that consumption's going to fall. Business investment's going to fall for the same sort of reasons. It's more expensive to take out business loans, and that's going to slow down the economy, cool it down a bit. Let's look at exactly the opposite situation. Our economy is a bit sluggish and we want to try to, speed things up a bit to stimulate it. Well, you've probably already heard this sort of rhetoric in the news, particularly over the last 12 to 24 months. How are we going to stimulate the economy? We're going to cut the cash rate. So the RBA is going to lower interest rates. What does that mean? Well, I could keep my money in fixed term deposit, but to be honest, I'm not earning very much anymore. May as well do the things I've always wanted to do. That loan for a motorbike's not so expensive anymore. Maybe I'll do that. Or you're a small business owner, you've been thinking about expanding your coffee shop to buy the store next door and add a little restaurant section, but you're going to have to get a small business loan to do that. Well, now you can get that small business loan at a lower interest rate. So that's going to increase demand for real goods and services and investment, all these things that we know contribute to our GDP. So what are the open market operations required in order to lower the cash rate? Well, this time the RBA is going to buy back some of these government securities from the banks. The banks are going to get this injection of money, which means that they're less likely to have to borrow in the overnight market, and that therefore means that there is going to be downward pressure placed on those interest rates in the overnight market, which, as we know, flow on to the everyday interest rates that you and I see on a daily basis. So that's about setting the target cash rate and then trying to get us as close as possible using these sorts of operations afterwards to sort of to tweak it, so to speak. But surely the RBA, even though it's the big and powerful central bank, doesn't have enough of an influence to be able to affect the money supply in a way that meaningfully matters to an entire economy. It doesn't have those sort of reserves. Well, let's see how it can actually change the quantity of money using what's called the money multiplier. So that is the influence of these sort of policies whereby the RBA affects the quantity of money supplied have a much bigger impact than just that initial injection. And that's what we call money creation. So let's see how this works. And it's all got to do with the fact that we live in a fractional reserve system. Fractional reserve system means that commercial banks don't need to hold all the money that you give to them. So you give them $1,000 into your bank account. You'll see that whenever you go into your internet banking, there's your $1,000, but it's not sitting in the Commonwealth Bank's vault. In fact, they only have to keep a fraction of that. Now, that fraction can differ from bank to bank, but let's make it simple. It's usually around that 10% level. What are they doing with the rest of it? Well, they're using your money to try and make a profit, typically by investing it in things that would be quite difficult for you to do individually. So it's sort of a win-win sort of situation. So let's imagine that the banks are holding these sort of 10% deposits. Then we're going to say that the reserves are the deposits that the banks have received but not given out. So maybe they keep that $100, and that then tells us what this reserve ratio is. That's the fraction that they hold compared to what they give out. So in this case, a 10% ratio. So when the deposits are put into the bank, it's recorded as both an asset or a liability. So these sort of loans to the bank become an asset for the bank. So let's take a very concrete example to see how this might work. Suppose the RBA decides that it wants to buy back government securities. So say it buys back a $1,000 bond that Tian has previously bought from the RBA. And let's say that Tian is a customer of the Bank of Alexandria. So then the RBA transfers $1,000 from the government's account to the Bank of Alexandria. So in effect, the monetary policy by the RBA is to buy back government securities. In this case, the injection from the RBA is $1,000. That's how much money the RBA has spent to increase the money supply. What we want to find out is what's the final effect on the money supply. So this is what the Bank of Alexandria's balance sheet looks like if you've done any accounting before. The Bank of Alexandria decides to hang on to $100 in reserve, and then it loans $900 to somebody else as part of its sort of profit garnering activity. So in this case, let's imagine that it loans $900 out to Emily. So that $900 now sits on its asset side of its balance sheet. And Emily has $900. She's taken out a small loan from the Bank of Alexandria, and she buys a sofa from Julian. Julian takes his $900 and he deposits it in his bank. We'll call that the Olympia Bank. Now, if we look at the Olympia Bank's balance sheet, it's now got this reserves plus $900, deposits plus $900 on its assets and liabilities side. What that means is that if we look at the Bank of Alexandria's balance sheet and we look at the Olympia Bank's balance sheet and we add them up, we'll see that in total, $1,000 plus $900, $1,900 has been created, but only $1,000 was injected by the RBA. Now we can go further. We can say, what does Olympia Bank do with the $900 that Julian deposits there? Well, it keeps 10%, 90, and it loans out 810 for some other profit-making activities, such as loaning it to Sanvi. So it loans out $810 to Sanvi. Why did Sanvi borrow that money? Well, maybe he wanted to buy an espresso machine from Kofi. Kofi deposits $810 in his account at Colossus Bank, and we need to add on that extra money created on the Colossus Bank's balance sheet. It could, of course, be that Kofi was also banking with Alexandria, in which case we'd add on an extra $810 to Alexandria. Either way, when we add up the money created on the bank's balance sheets, we can see that it keeps getting bigger and bigger, more than just that $1,000 which was thrown in the first place. And this is all because of this fractional reserve system. Now we can keep going and going following the same sort of pattern, and if we do this, assuming that every one of these banks is holding 10% as its reserve ratio, we find that the money created, well, it follows this formula, is equal to the change in the monetary base, that's the injection from the RBA, divided by the reserve ratio, which here is 10%. So in this case, a maximum of $10,000 can be created from an injection of just $1,000. Now, of course, these numbers can change a little bit, but still, this 1 divided by the reserve ratio represents the money multiplier, which tells us how much more the RBA's effect of the monetary base has affected the overall money supply. So that's great. It means that the RBA has more power than we thought before to affect things like the interest rate. On the other hand, the RBA has got a couple of problems that arise due to fractional reserve banking. It can't control things like how much money you and I decide to keep in the banks. If we want to put it under our pillows, it can't stop us from doing that. And it can't control the amount of money that bankers choose to lend. So what does it do about these things? Well, let's look at things in a graph. Now that we're used to supply and demand graphs, let's take a look at the money market. And it sure does look similar to different supply and demand graphs that we've seen before, but there are a couple of differences. First of all, note that we don't have our quantity on the x-axis. We've got this M divided by P. We've got the money, either supplied or demanded, so the stock of money in the economy, divided by P. That's the price level, the overall price level, just in the same way that we saw the consumer price index is talking about sort of a bundle of goods. So basically what we're looking at there is the quantity of money controlling for the price level, or keeping that price level fixed. Now, what about on the y-axis? Well, we used to have price there, but now we've got the interest rate. Why have we got the interest rate when we should have the price? Well, to work that out, let's first go to our two curves that we've got on there, the supply and demand curve. And we'll start with demand. That's a little bit easier to understand in the first place. So what does it mean to demand money? The simplest way to think about this is to imagine that there are only two things that you can do with your money. You can hold on to it, keep it in your wallet so that you can spend it, or you can put it in some sort of, let's say, term deposit where it earns interest. Say those are your two options. You hang on to money, put it in your wallet so that you can buy stuff. You can spend it on things, same way that businesses use it so that they can spend it on factors of production. The alternative, we've got the alternative now, that's getting interest. When the interest rate is high, the opportunity cost for money is high, because what's the next best thing? Well, it's putting it in term deposit, and you can do a lot better when the interest rate is high. So then the quantity of money demanded is low. When the interest rate is low, on the other hand, then the opportunity cost of money is low. You couldn't do much better by putting it in a term deposit. You may as well spend it. So the quantity demanded of money is high. That explains why our money demand curve slopes down. So here we're really talking about the opportunity cost, and that gives us our price. So we've got here the price being the interest rate. What about on the supply side? Well, monetary policy in Australia is really about using the supply of money to target an interest rate. So we've got a target inflation rate. That means that with that target inflation rate, the RBA sets a target cash rate, which it does every month on a Tuesday, and announces it to the market. And to get towards that target cash rate, it adjusts the supply of reserves and currency that it's got. The quantity of money supplied is adjusted to try to maintain a constant interest rate. Now, it doesn't get there exactly, but it gets very, very close to it. So what that means is that even though it's adjusting the money supply to set levels, which can be depicted as vertical lines at the amount of supply that it wants to put in, the end result is really to narrow down a constant target interest rate. So it's a lot easier for us to think about this in terms of an elastic money supply, that is just setting it exactly at the interest rate that it wants to be, and when it changes that target interest rate, we just move that line up or down. So what's equilibrium in the money market? Well, it's about the quantity of money that the central bank supplies via these open market operations we spoke about to hit that interest rate, that target interest rate equal to the target cash rate, or I, such that the quantity of money supplied equals the quantity of money demanded, controlling for prices, this MP. Now this is all done holding not just prices constant, but also holding income constant, because if you have more money, say that you were unemployed and now you get a job, sure, those opportunity costs come into account, but you still might decide it's worthwhile borrowing now. At least the money that your demand for money might increase after that, for example. So if your income rises, we will see the rightward shift of the demand curve, the money demand curve. And if the central bank wants to try to continue to hit that target cash rate, it's going to very, very quickly adjust the market supply in order to make sure that that money supply curve stays nice and horizontal. So this is nice because it shows us how we get the money market equilibrium and the effect on the interest rate in a simple setting, a simplified supply and demand model that we're used to. And that's all you really need to capture for this part. But just for completeness, I will mention that there is more to this story. It's a little bit more complicated what the RBA does. It may not be of interest to you, but the RBA does go to some lengths on its website to describe the differences between what an economics textbook says, and which is what we've discussed so far, and the actual processes that it undertakes. And I guess it's the RBA sees that there is some importance in making this difference known, so I feel obliged to tell you about this. The main difference has got to do with this channel system, in that the RBA sets what it calls a policy interest rate corridor around its target interest rate, where it has a lending rate that's usually 0.25% above, and a deposit rate 0.25% below whatever its target cash rate is, which sets this policy interest rate corridor. In effect, what it's doing is it's setting a ceiling and a floor, such that the banks have got no incentive to go above that ceiling or below that floor, and then the open market operations help to get the banks to trade with each other within that sort of corridor to reach as close as possible to that target cash rate. And in practice, they do very well and they get extremely close to that rate. And there's a little bit more information on this website below in case you're interested in reading about this, but I see no need to really complicate things too much further at this point. So we've kind of started in reverse a bit, because we've mainly been talking about how the RBA changes the target cash rate, but not why the RBA would change that target cash rate as much. A little bit about this overheating and underheating, but let's talk a little bit more about this monetary policy and why it does what it does. So in particular, the central bank may want to respond to changing GDP from a change in, say, the AD curve, as we saw last week, which can affect our overall Y in our AS model, to try to preserve its target cash rate. We saw last time that these sort of shifts, such as a shift of the AD curve or a shift of the SRAS curve, can put pressure not just on the Y but also on inflation. And the central bank may wish to do something about that, or it may also wish to change that target cash rate. There are two types of monetary policy it can put in place: expansionary monetary policy and contractionary monetary policy. And we've actually already seen examples of both of these. So expansionary monetary policy, you want to lower the target cash rate, and you do that through a corresponding increase in the quantity of money supplied or injected into the economy. Conversely, a contractionary monetary policy is one in which you want to raise the target cash rate through a corresponding decrease in the quantity of money supply. Let's look at the differences of these two things on our money market graph. So in the first case, we are going to try to engage in expansionary monetary policy. We want to stimulate our economy. We want people to spend more money, to borrow more money, so we need to make it attractive for them. We need to increase the price of holding money. In other words, we want to lower that interest rate. So we want to do that by increasing the money supply. Exactly the opposite happens when we set a target cash rate that is higher than our current one. So that's contractionary monetary policy. In that case, we need to decrease the money supply. And to link this in to what we've seen before in our ASAD model, let's look at the interaction between monetary policy and the aggregate demand curve. And actually, the attitude that the central bank takes to inflation targeting affects the slope of the aggregate demand curve in our model. And that's got to do with how quickly or how aggressively the central bank wants to respond to other shocks to our economy that will affect inflation. So let's see an example of that, and we'll look at both a responsive and a not so responsive central bank and see how it affects our AD/AS model. So let's suppose there's some shock to the economy, such as that suddenly there's a mining boom in Australia at the same time that there's a construction boom in China, and there's a big increase in demand for Australian iron ore. That's going to shift the AD curve to the right. Now, in the case of a responsive central bank, we've actually got a relatively flat AD curve. And how do we see that? Well, for a responsive central bank, when the shock happens that moves our AD curve from AD to AD1, here this is the horizontal distance that we've moved to the right, that puts pressure on interest rates to rise, as we've seen. So we move across to the right, big increase in Y, and then slowly that puts pressure on inflation to go up. So we move up and to the left along the AD1 curve until eventually we get to a point here at the new equilibrium where we're at the new Y1 and a new Pi1. So a slight increase in inflation. And note that as we saw last week, even though from the starting equilibrium to the final equilibrium, it looks like we've moved up and along the SRAS curve, the actual process to get there is a bit more involved because it involves first a shift to the right with an increase in income, followed by this pressure on inflation, which leads to a fall in Y. Now, what about if we have an unresponsive central bank or a less reactionary central bank? Well, we're going to look at that situation, but there's going to be the same shift to the right. So even though the graph looks a lot different, the movement from AD1 curve from AD is exactly the same length horizontally. But we represent an unresponsive central bank by a steeper AD1 slope, because after moving to the right, there's then that pressure on inflation. We move up and to the left along AD1, which leads to overall a much bigger increase in production and a much bigger increase in inflation. So that's when the RBA doesn't put a lot of effort into changing the interest rate, for example, trying to cool down the economy with contractionary monetary policy. So there we can see the connection between the responsiveness of the central bank and the slope of the AD curve. I've also got a couple of little flow diagrams here to reiterate the point once more, but we've seen these already, so I won't go through it too much, but it just reiterates what we saw on the last slide. Now, another thing to mention, so we just looked then about the interaction between the monetary policy and the AD slope. We can also think about how monetary policy shifts the AD curve. So if the central bank wants to adjust the interest rate for reasons that have to do with inflation changes, that's going to talk about the slope of the AD curve. If it's to do with anything else, so if the central bank wants to react and change its cash rate for something that's not got to do with inflationary pressures, then we're talking about moving to a new curve, a shift of a new curve. In the same way that we've looked before with our micrographs about movement along the curve being to do with price and shifting of the curve being anything else other than price. So why would the central bank want to change the target cash rate if it didn't have to do with inflationary pressures? Well, it can happen in particular if there's a special type of asset bubble that it thinks happening. So it's not about overall inflation, but there's an important part of the economy that it thinks is the prices are growing beyond what their true values are, such as housing market bubbles, which many economists argue are something we haven't in Australia today. So this is something that's affecting monetary policy, but it's not linked to current changes in inflation. So we call this an exogenous monetary policy, and that shifts our AD curve to something else. Okay, we're going to leave monetary policy for a moment and get more into inflation, which we spoke about a little bit already for the last couple of slides in this lecture. So here we go then. Inflation measures the change in the aggregate price level, and typically we think about it as in terms of changes over time, in the same way that we compare GDP over time. We typically have our inflation rate as a percentage change from the corresponding month in the previous year, or the corresponding quarter in the previous year. Now, this is to take account of seasonal differences in production and consumption. For example, it doesn't make too much sense to consider December 2018 versus June 2017 when taking an annual inflation rate, because December is sort of a special month for consumer spending and production. So we try to compare the same months when we do it, or at least the same quarters. And inflation targeting is what essentially the culmination of what we've seen over the past hour, which is the use of monetary policy to try to keep inflation within some particular band that is low and predictable. Now, these are reasonably modern macroeconomic policy objectives for most central banks. We'll see that macroeconomics is not what we have seen, and we will see again next time, that macroeconomics is not a very old science. In fact, it's reasonably modern, and actually the Great Depression was one of those events for the world that spurred this sort of science into action. So even for something like Australia, you can see that we had large swings in the consumer price level, much larger swings than we would see today, for long periods of time, going back a generation. And then since 1993, it's really started to smooth off. You can see it here. So it's sort of hovering around this 2.6, but really within that 2 to 3 sort of band for the most part. That's the aim of the RBA, and it's done a much better job at reducing this sort of volatility. So why does it want to do this? Why does it matter that something is quite volatile? Well, when things are volatile, they're uncertain, and having this sort of narrow band that the RBA targets helps to reduce this sort of uncertainty. And that's important for both you and I as consumers, and also for businesses, for production. Workers and firms need to have some sort of idea of what wages mean when you go for an employment contract. What does this mean in terms of how much value am I getting? I can see what the dollar amount is, but I need to know how much these dollars are worth on the contract. When my employer, the University of Queensland, employs me, and they say that next year my wages are going to go up by 2%, doesn't help me if the price of everything I have to buy goes up by 20%. I've just gotten poorer, essentially. So we need to know a little bit about what these sort of things mean, so that when we negotiate these contracts, we're both happy with the result. If there's uncertainty, we might decide to pull out. Also, for any sort of investment, particularly business investment on capital, higher inflation rates are associated with more volatile inflation, as we saw in the previous graph, big sort of swings. And when it comes to corporate finance, there's a risk-return trade-off. So people try to reduce their risk, sometimes even at the expense of a reduced return. So we really want to keep that volatility nice and low. So what do we target then? Well, it doesn't actually matter so much theoretically what rate we go for. In Australia, it's 2 to 3%. As you can see, other banks are in that ballpark, but not always exactly. It's nice to keep that target rate low, particularly in a country that's growing at a small but steady rate. It keeps the inflation, keeps the volatility low, and it reduces the impact of this sort of inflation on people with fixed nominal income. So say you're getting benefits and pensions, or any sort of thing which is not indexed to inflation, every year you're getting $50,000, but the prices are going up. You want to keep that target rate low so those people aren't disadvantaged too much. So why not zero? Well, zero is not so good because there's a risk that things happen that move you into the negative sphere, which we call deflation. And deflation's not good because then you expect prices to fall. If you expect next month prices to fall, then if you were thinking about buying clothes today or an iPad or a car or whatever, you won't do it today because you think that it's going to go down in the future, the price of that good. So that postpones consumption, postpones firm investment, and that in turn cools down our economy to the point where our output might actually fall. Not just fall below trend, but fall. What are the other costs of unanticipated inflation? So we're told that next year prices will be 2% higher, but they turn up to be 5% higher. What's wrong with that? Well, when there's this sort of volatility, it's hard to know where you should allocate your money efficiently, allocate your resources efficiently for both individuals and for firms, which means that if we're not allocating our resources efficiently, we've spoken a lot in microeconomics about allocative efficiency, the pie is smaller for everyone. There's also going to be reduced purchasing power for those who are on fixed sort of incomes or benefits, like pensioners, for example, or self-funded retirees who had planned for their future with a certain inflation rate and income stream in mind. Also, if you've lent money at a fixed rate, I give you $100, next year you give me $120, but inflation goes up much more, and this isn't good for me, and in future I'm not going to want to lend if these sort of risks are on the table. But there are some winners, people who have borrowed money at a fixed rate. Say I've got a home loan and I've borrowed it for 5 years, at 5%, and suddenly inflation goes up by a lot, but I only have to pay 5% in terms of nominal amounts. I've won. So there are some small winners, but overall the losers outweigh the winners. So I mentioned nominal. Now we've spoken already about nominal GDP and real GDP, and the same applies when it comes to interest rates. We've got the nominal interest rate and the real interest rate. And the real interest rate, we've got to subtract off that inflation. So, as I mentioned before, if inflation is higher than expected, it's good for borrowers who are borrowing at a nominal interest rate, and that's why most home loans don't have a massive fixed component. They often have that variable interest rate component that is quite large. Often you'll go for a home loan and they'll say, okay, you can have a fixed portion, or it can be fixed at a fixed interest rate for 2 years, but after that it's got to be variable. So basically the banks are trying to ensure that if there is unanticipated inflation increases, they're not completely wiped out. They've got that ability to sort of moderate the rate that you have to pay them back. And it is possible for the nominal interest rate to be less than the real interest rate in those rare times where we have deflation, but that's very rare, particularly for Australia. So, what causes inflation? Now, this seems like such an easy question, and if I asked you right now, or you asked anyone on the street, they'd say banks printing money. Government prints more money, central bank prints more money, there's more money around, each dollar's worth less because there are more dollars out there, so the value goes down. Well, this is one way that inflation is caused, and it's actually the argument put forward by Douglas Adams in his fantastic novel, The Hitchhiker's Guide to the Galaxy, when the primitive Earth civilization uses tree leaves as their source of currency. However, it's not the full story. In fact, this is not the main reason in reality that inflation occurs. Sometimes the central bank or the government choosing to print money exacerbates a problem with inflation, but that's sort of a consequence of an initial cause, a symptom of the initial problem. And usually these problems come from one of two sides, the demand side or the supply side. Now, if you remember our graph, supply and demand graph, typical microeconomic model, what causes an increase in the price? Well, one of two things, one of two shifts can occur. Demand can increase, or supply can decrease. So demand curve shifts to the right, supply curve shifts to the left. If either of these things happen, the price is going to go up. Exactly the same way when it comes to our graph, the economy, inflation will go up if the short run aggregate supply curve moves to the left or the aggregate demand curve moves to the right. Now, In the latter case, demand pull inflation ensues. So that's anything where a shift of the aggregate demand curve to the right is putting upward pressure on inflation, particularly in situations where production can't keep up with this increase in demand. And that can happen when growth in a country is too rapid or real wages increase too quickly. It's less common, and when it does happen, it doesn't usually lead to massive increases in inflation. But the big inflation problems, the ones that are historically and politically so prevalent and so salient, have often got to do with effects on the short-run aggregate supply curve, and we call those cost-push inflation. That's when there's an increase in costs for firms, for example, and that shifts the short-run aggregate supply curve to the left, or a whole bunch of production is just wiped out for one reason or another. So, for example, in the 1970s in a lot of Western countries, increases in oil prices really affected those countries that relied so heavily on production, with oil being such an important input cost into that production. So that led to the SRAS curves moving to the left, which put upward pressure on inflation for a lot of these countries. But there are a lot of other examples, and like I said, just wiping out a lot of supply in one go, such as when a hurricane hits or war occurs or something like this. These are all going to be things with a large effect on inflation. And when that happens, that can lead to the government finding itself in financial difficulties. In particular, what's the main source of government revenue? Well, it's income taxes. And what could possibly reduce that income tax revenue? Well, if people aren't working anymore. If people are unemployed, the government's not getting paid. In fact, the government has to pay them unemployment benefits. So if something happens, such as a war or a hurricane or a tropical storm, wipes out a lot of production, you have a lot of unemployed people, the government's reserves go down by a lot. Or in the case of Venezuela, for example, the government was receiving massive royalties from oil. About 80 to 90% of Venezuelan GDP was reliant on oil. And when those prices dramatically dropped, so the oil market prices dropped, not only did it affect domestic production, but it affected the government's treasuries. And when that happens, the government can find itself in a situation where it needs to get money quickly, so it prints money. It prints a lot of money. And when that happens, you start to get this cycle. So the printing of money comes as kind of like a secondary thing, a symptom, on top of that initial, usually cost push reason for why inflation occurs. And that can lead to a spiral, which you would have heard of as being called hyperinflation. Now, in Australia, we talk about keeping to that 2 to 3% inflation band. 5%, 6%, 10%, that would already be bad for us in Australia. But hyperinflation can sort of go crazy. So you end up in this situation where there's a massive government revenue deficit from some sort of negative supply shock. This was something, so when I talk about the Rome crisis of the 3rd century being due to them devaluing the currency, the silver coins, that pressure to do that was because they needed money to try to sustain the empire and their constant conquest expeditions by the army. But overall, this devaluation exacerbated the situation and eventually led to the destabilization of the entire Roman Empire. Other situations where there have been these big leftward supply shocks and the government has been unable to deal with them include Germany after the First World War, leading up to the Second World War, and that was exacerbated not just by the huge resource losses from the First World War, but also the debt that was accrued through war reparations, and that led to hyperinflation. Hungary was hit particularly badly after the Second World War, to points to the point where their notes were just not worth anything at all. And what they eventually had to do was to change the currency to a completely new currency, which is often what happens in cases like Zimbabwe, which you would have heard about before, and in other countries, particularly in Africa or South America, when hyperinflation has ensued. Quite often it gets to the situation where the locals just can't trust the currency anymore, that national currency. It doesn't fulfill that important purpose as a store of value anymore, because you don't know what it's going to be worth tomorrow. It might be worth half or even less of its value. And that means that as soon as you get paid any sort of money in your local currency, you need to spend it as quickly as possible. But that is leading to a rightward shift in the demand curve to go with a leftward shift in the supply curve. And you can see this cycle is sort of continuing and continuing. So as was the case in Hungary, and also in the case of these other historical examples in modern times, usually the best thing to do is to shift to a new stable currency, typically US dollars. So typically US dollars are used. Sometimes British pounds have been used as well. In the case of Venezuela, there's been a movement in recent years to use commodity money rather than fiat currency. So they've been using things like eggs, things that have tangible value and that can be trusted to be worth something. However, the Venezuelan government now has introduced some sort of cryptocurrency as another means to try to replace the previous disaster and start again eventually. Here is a graph that shows what's happened in Venezuela. It is just a heart-wrenching example in recent times. The scale that I've got on the y-axis there is a logarithmic scale. What that means is that every time you go up by the same amount, you're multiplying by 10 every time. So the value is just getting less and less by 10 times at every amount. And that's the only way to draw it on the chart, because otherwise it just goes off the chart. But hopefully, by trying to restart again with the currency to try to build a bit more faith in the institutions and the national currency, and also in the future to adopt a better macroeconomic policy whereby you don't put all your eggs in one basket, so to speak, by relying too much on one sector, on oil, the Venezuelan economy can recover to its full potential again. So I hope you've enjoyed this lecture on money and inflation. Next week we'll continue with our discussion of macroeconomics. I've been David Smerdon. Thanks a lot for listening. Bye.